Hello and welcome to the third instalment of the Investment Insight series, Magellan Minutes. We aim to bring our investors timely, relevant and thought-provoking investment insights all in around 10 minutes. It's been great to see the positive feedback we've received since we started the series about a year ago. A lot has happened since we caught up in December, with the vaccine rollout progressing well globally, and also with the effects of the stimulus packages we've seen washing through the system. From ESG to infrastructure, luxury to financials, we discuss the issues and the developments in the sectors and stocks in our global portfolios. My name is Jennifer Herbert. I'm a key account manager at Magellan. And today I'm speaking with Magellan's Head of Financials and Portfolio Manager, Alan Pullen. Today we're going to discuss the impacts of inflation on banks, how ICE has performed since coming into the portfolio, and what the term DeFi means and how it might affect stocks that Magellan covers. Al, thank you for joining us today.
Thanks so much for having me, Jen.
Recent talk about inflation has had quite negative connotations for a lot of stocks. Why would it be a different situation for banks? Why would banks welcome inflation and potentially a rise in rates?
Oh, that's a good question, Jen. Obviously, this is the big debate in finance and markets at the moment. Everywhere you look, everybody's wondering what's going to happen with inflation and what's going to happen to interest rates. And it is really important for markets as a whole because, of course, we all use discounted cash flow valuations. And if we put the interest rate up, the value that you should be willing to pay for a stock goes down. The interesting thing for banks is actually they do have some direct benefit from higher rates. They obviously pay very little on their deposits at the moment, but they receive on their lending at current interest rates. So if those rates go up, we'd expect the amount that they earn to improve over time. So they're actually likely to be a potential beneficiary of higher interest rates.
So who would be a beneficiary of these high interest rates, and is that already factored into their valuations?
Well, it would be traditional retail banks, the likes of US Bancorp and Wells Fargo that we cover, Lloyds in the UK. The Australian banks also potentially beneficiaries there. But we do feel that to a large degree it's kind of been priced in over the past 6 months. And the future is still uncertain. I think what people aren't thinking about is the potential for a worse economic outcome, either due to mutation risk, which looks more limited at the moment with a successful rollout. But the thing is about inflation, it really only works if we get this Goldilocks scenario of a little bit inflation, but not too much. If you actually get inflation going too high, then the central banks will be forced to raise rates more than people expect. Now, there's some benefit on net interest income there, but if they have to raise rates significantly, there's actually a big impact there on economic activity. There's a potentially big impact on credit quality, which has been so good due to the stimulus payments and so on. So you could see all that reversing. And just given the what's baked into the share prices at the moment, we think that should give investors pause, in particular when you consider the longer-term risks from fintechs coming into the market and technology companies pushing into banking services, which is why we're wary over the long term already. So taken together, we're still fairly wary on banks at the moment.
Last time we caught up, ICE, or Intercontinental Exchange, was a new addition to the portfolio. So how has that stock been performing, and what would your comments be about current valuations?
I think we spoke quite a lot about ICE last time. It was a fairly new addition to the portfolio and a stock we're really excited about the long-term future for. We talked about their strength in derivatives exchanges, which we consider a really high moat, stable business, and some of the information services we're providing. They say data is the new oil, and they've got really strong data assets across fixed income and financial markets more generally. And we were really excited about the opportunity in the mortgage business. They'd recently acquired a few businesses and put them together, and we're looking to digitize the US mortgage market. Still very analog, and that's a very long-term kind of growth driver for that stock. So just as a quick update, I mean, it's really performing as we'd hoped. The exchanges business has been really solid with a bit of extra volatility around oil prices and financial markets. That's benefited volumes for exchanges. Data is continuing to grow at a really steady rate. People are just consuming more data. They just need more data. And putting AI and machine learning behind it, you can get greater insights. So we think that's a steady driver. And the mortgage business is performing really, really strongly. That's in part due to the low rates that we've had in the US. So there has been a boom in refinancing. In the US, unlike the Australian market, it's a 30-year fixed income market. And when you do see rates on that long-term bonds come down, you get a lot of people refinancing their mortgages. And that's been really positive for volumes there in the short term. That's not why we really like the mortgage business for ICE, I should say. We really like the structural growth as they digitise this market, and there will be some inevitable slowdown in that refinance market as rates start to go up. And we're starting to see a little bit of that now. That doesn't concern us in the slightest, I'll have to say. We think the long-term growth from the digitisation of that market, from ICE mortgage services, taking market share, but also doing more for the players in that industry, adding more AI, data, adding more electronic kind of connections to third parties for things like flood insurance and mortgage insurance and all the stuff you need to do when you're doing a mortgage is still a tremendous long-term opportunity.
I'm seeing something in the headlines called DeFi. What actually is that, and how could that affect some of the stocks that we have in the Magellan portfolio?
Yeah, that's an interesting question. So DeFi stands for decentralized finance, and it's actually using the technology that underlines Bitcoin and other cryptocurrencies to undertake financial transactions. So lending and borrowing or exchange transactions, for example. Now, we don't think much of cryptocurrencies. I won't get into that. But we do think the technology underlying it, the distributed blockchain, is quite interesting and potentially has a use in financial markets. Now, when you think about financial markets at the moment, it's mostly done through a centralized party. Your bank sits between the borrower and lender. An exchange sits between you when you're buying a stock and somebody selling the stock, or us when we're doing international transactions. There's always a centralized counterparty there. And DeFi is betting that the blockchain can actually take the part of that centralized counterparty and offer a more efficient method for doing certain activities. Now, it's really early days in this, and we don't think it affects a lot of our stocks at the moment, but it's just something we want to be watching. Where I think it could be at risk is potentially where something can be done more efficiently. So for traditional banks, they play a number of traditional roles, but maybe something like peer-to-peer lending, which is done through a central counterparty, that can be done more efficiently through a blockchain type mechanism. Some international transactions, for example, which are still high fee and high complex, somewhat analog, can be done more efficiently through that. Even things like custody and so on, where we own stocks and it's held through a State Street or Bank of New York Mellon, where those processes can be made more efficient, I think there's a potential risk. So it's something we really want to watch.
Al, thank you for your insights today.
A pleasure.
And thank you for watching. If you have any questions, please don't hesitate to reach out to the Magellan distribution team, and feel free to share this update with clients and colleagues as you see fit. Thank you.